I want to welcome a member of the client team that many of you know, Evan Witkowski. Evan's going to cover fund attribution today. Evan, welcome. It's great to have you here.
Hi, Joe. Thanks for having me this time around. I've never dreamt of being on the big screen, so this is a bit special for me. But enough with the introductions. Let's get on to performance. This chart shows the net of all fee performance of the individual Wespath funds versus their respective market indices. Today, I'm going to focus primarily on the second quarter performance and also highlight the year-to-date fund returns. Joe, I know you mentioned in your blog recently that this has been the second worst year of a 60-40 balanced fund going back to 1977. If this is the second worst year, I have to believe this ranks as one of the worst quarters for a balanced fund.
Yeah, and one of my former colleagues, John Halwax of DBG Solutions in Minneapolis, he posted some research, and it shows that this is the worst start to a calendar year in a 60-40 portfolio since 1932.
Well, despite negative absolute returns, the multiple asset fund outperformed its benchmark by a modest 10 basis points net of fees for the quarter. The U.S. equity fund underperformed its benchmark by 36 basis points. We will talk a little bit more about this later. The international equity fund inched out by 7 basis points against its benchmark. The two bond funds that comprised 35% of the multiple asset fund were split against their benchmarks. Then the fixed income fund underperformed by 64 basis points, and the inflation protection fund outperformed its benchmark by a whopping 3.41%. Looking at the year-to-date performance, the multiple asset fund's biggest detractor was the international equity fund. If you look around the long term, it is actually outperforming its benchmark across the 3-year time periods and longer.
So Evan, can you tell me how the multiple asset fund has performed historically during and following a market downturn?
Great question. The next slide may look familiar as we often show this drawdown chart with the S&P 500. This exhibit showcases the multiple asset fund, which has history back to 2002, of which we can make several observations. Despite average intra-year declines of 10% since 2004, annual returns for the multiple asset composite were positive in 14 of the 18 years. As of June 30th, 2022, we are of course in a drawdown period of negative 19%. Historically, the multiple asset fund has experienced larger drawdowns, such as during the pandemic period, negative 25% in March of 2020, and during the global financial crisis, negative 39% in March of 2009. The performance rebound and recovery period took 20 months following the global financial crisis, but only 4 months following the pandemic-induced drawdown.
Are drawdowns common?
People use the analogy that markets can be roller coasters. Yes, drawdowns are common, but the multiple asset fund has always recovered. Since 2004, the multiple asset fund has experienced double-digit intra-year drawdowns in 6 calendar years prior to 2022. While in only 2 of these 6 years, the fund ended the year in positive territory, in all 6 years, it generated positive returns the year following a double-digit drawdown, with an average return of 15%. It's important to remember, too, that the fund is a well-diversified strategy among many different asset classes, managers, and styles. As in any market cycle, the leaders will also sometimes be laggards. When we did this webinar a year ago, our 3-year was in the 35th percentile, and everything beyond was in the top quartile. According to one of our managers, Wellington, 80% of asset managers fall below median of a universe on a rolling 3-year basis at some point. Underperformance happens, but as both an asset manager as an asset owner, this makes us think twice about abandoning our long-term strategy. So then looking at the 1-year multiple asset fund, it's currently in the 90th percentile. However, the 3, 5, 10 are still above the top half against its peers. Overall, the multiple asset fund outperformed by 25 basis points in the quarter, gross of fees. We will spend time discussing each underlying fund's performance. I want to begin our U.S. equity fund by highlighting a new segment we created called Unscripted, a conversation with Wespath's asset managers. This quarter, our manager of public equities, Mark Warren, did a segment with Brown Capital Management. If you would like to hear more, please head to wespath.com or connect with a member of our servicing team for more details. The U.S. equity fund saw its worst quarter since I began at Wespath in early 2020. In an environment where no major equity markets are doing well, there are some things to look forward to.
So what should investors be optimistic about in this down market?
Joe, great question. Before I can get into what investors should be hopeful about, each month this quarter was in the red. April and June were down 8.9% and 8.6%, while May was flat. However, on the positive side, our belief in maintaining an underweight to mega cap propelled the portfolio along with the diversification we bring through our alternative investments, including private equity and real estate. Alts contributed about 0.9% to the relative return, while making up about 6% of the portfolio. It seemed that from 2019 to 2021 that mega caps just dominated. Our underweight is playing out favorably here. Secondly, investors are benefiting now with diversification in value, which makes up 56% of our portfolio and has been outperforming growth for the year to date. Lastly, we regularly poll our managers about their sentiment. Going forward, one comment that stood out to me was from our manager, DGI, who said, "Periods like these allow us to set up the portfolio well for the strong return potential going forward."
So then what's been hurting the portfolio?
Well, when the Federal Reserve increases the Fed funds rate, it immediately elevates short-term borrowing costs for financial institutions. Businesses are not only affected by higher borrowing rates, but also consumer demand for the products can slow as costs increase. First, our overweight to small and mid-cap growth was a detractor. Applying that interest rate concept to our growth manager, Zevenbergen, we learned that in periods of underperformance, they not only bounce back, but they find companies with rare compounding ability. Let me provide an example. Tesla, although down 38% this quarter, it is up 12,180% over the past 10 years. Additionally, compare that to the S&P, which is up 233% over the same period. Our long-term nature enables us to wait out companies that will create value over the long term.
So what about international equities?
Well, let me begin by stating that this is also a similar quarter. April and June were down 6.3% and 9%. Not as bad as on the US side, but let me remind everyone that almost every major asset class was down for the quarter. In essence, there was nowhere to hide unless you had a barrel of oil to sell. Alts contributed again, making up 1% of the relative return, while making up about 8% of the overall portfolio.
So then on the downside, aren't rates hurting our growth managers in the portfolio?
Yes, and I should say underperformance is slight, but e-commerce, which didn't do well as a direct result of these growth companies being out of favor as central banks across the world raise rates to combat global inflation. One of our longest standing international managers, Baillie Gifford, is a highly regarded investment manager based in Edinburgh, Scotland, founded in 1908. Baillie follows a growth-oriented investment approach, which leads to a portfolio that tends to be more volatile than the overall market and its benchmark. One such company that detracted was Zalando, down 50% in the second quarter. They engage in the provision of online fashion, and it's also a lifestyle platform. It offers shoes, apparel, accessories, and beauty products. I think we hear about growth companies at times not earning any income. Well, Zalando had a positive net income in 2021 and is also projected to earn 91 million euros as of year end, according to FactSet. Another company that Baillie has held for more than 10 years is Mercado Libre, down 46% in the second quarter. It has suffered 7 drawdowns of more than 30%, but it's generated a 17x return over our holding period. The key to our managers like Baillie is that we rely on them to find companies that are in the top quartile of earners. Lastly, I just want to mention that Mark Warren, again as part of our unscripted series, interviewed Lawrence Burns of Baillie Gifford.
Great, so what can you tell me about the fixed income fund?
Yeah, well, the first reminder here is that rates compared to a quarter ago went up across all time periods on the yield curve. The basic rule is when rates rise, bond prices fall. Unfortunately, this affected our portfolio as we underperformed by 52 basis points. There are 3 main things to consider here. One is that agency commercial mortgage-backed securities are an 11% overweight against our benchmark. One of our managers was down 3% for the quarter, and these are shorter duration, less sensitive to interest rate changes, and higher quality because they are backed by government agencies. The second piece is our internally managed affordable housing program, running 30 years strong, which helped defend against the rate rises this quarter as we were down 1.9%. This continues to demonstrate that you can do well over the long term through impact investing. Finally, holding cash as an asset helped ever so slightly.
And what can you tell me about what hurt the portfolio?
Fixed income not being negative correlated to equities, like it typically is. Our overweight to high yield, when the high yield index was down 9.8%. Our two managers, Capital Group and Oaktree, were down about 9.5% in this space, both outperforming their indices. Lastly, being exposed to emerging markets currencies when the US dollar continues to be strong has hurt fixed income issues in local currencies.
So the Inflation Protection Fund seems to have outsized relative returns. So what can you tell me about this? And if inflation is so high, how come performance is negative?
The outsized returns come from the fact that we have a significant underweight, 30%, to UK inflation-linked bonds. These bonds as a segment were down 18% for the quarter. But let's decouple inflation from performance for a moment. We hear about inflation in our daily lives through the Consumer Price Index, and the year-over-year change in the basket of goods and services is up 9.1% in June. We're basically talking about two different periods, though. One is measured year over year. I'm speaking specifically to a change in the quarter. Commodities are certainly up year over year, but our manager, Gresham, was down 4.2%, while outperforming its benchmark by 1.4% due to an overweight in energy. I want to finish, though, by noting that US tips were down about 6.7%, and global inflation-linked bonds were down about 6%. I end the performance section, but want to acknowledge many headwinds. Even with consumer confidence at an all-time low, this may not be the end of more market declines. However, maintaining diversification across different asset classes should help provide support. When certain areas go down, other areas should go up. If your organization would like to discuss more, Wespath is here to help and provide reassurances throughout this challenging time.
Thanks for the performance update, Evan.